Thank you, and good morning once again. It's always a pleasure to talk to you. As you know by now, the Monetary Policy Committee meeting met yesterday, and they have taken a decision. And the decision, as I always start with the decision is to reduce the repo rate by 25 basis points to 6.5%. And that decision is on the backdrop of the fact that we want to continue to support domestic economic activity while at the same time maintaining the one-on-one link between the Namibia dollar and the rand. As usual, I will give you a quick summary of economic activities or economic developments that underpin that decision of the Monetary Policy Committee meeting. Starting at a global level, the picture has not changed from what we have presented before when you were here at the previous Monetary Policy Conference, that global economy is softening. We have seen that is happening in both advanced countries as well as emerging and developing countries. For 2019 as a whole, global growth is projected to be in the region of 3.2% compared to 3.5 in the previous year, 2018. So you can see it's still a respectable growth, but it's not rosy. Respectable because it's still in the region of 3%, and we all envy to be in that region, but not rosy in the sense that we are coming from high levels. As you know, that the global economy was growing in the region of 3.6, 3.7. Now it has softened, and of course it has been expected that growth will have to slow down. Global growth will have to slow down over time because otherwise some other economies will overheat. So you don't want the economies to overheat because that is not sustainable. The only concern is that the slowdown is now a little bit beyond expectations. And we hope that it will remain around the 3.2% and start to pick up again to something which is a bit more rosier than 3.2%. If you look at the response of many economies, especially a number of central banks, they have reduced interest rates, mainly to support economic activities. An example is the US, for instance, that cut interest rates few days ago. South Africa, our neighbor here, they have done the same. Other countries such as India, Brazil have also done the same. So central banks are responding to the softening of growth by cutting interest rates. There are risks on the horizon that could further negatively impact on global growth. Chief among those, you know by now, the trade tensions between our two biggest economies are not in the interest of global trade and therefore in the interest of global growth. So we just hope that those tensions will ease and amicable solutions will be found soon so that growth can continue to be sustainable. That is on the global picture. If we come to the domestic economic developments, again, in line with what we are seeing in the global economy and in line with what we have told you earlier, domestic economic activities continue to be weak. And that is on the account of sectors such as mining, particularly diamond mining is not bright this year, and that is mainly because one of the mining vessels went for maintenance. That has left a gap in production, and therefore the diamond activities are not as strong as they were last year. So hopefully when the ship returns back to production again, next year things will be better. Other sectors such as constructions, retail and wholesale trade, again, those continue to register weak growth rates. However, if you look at the sectors such as manufacturing, for instance, are doing reasonably well, manufacturing and and transport and communication. With regard to manufacturing, the subsectors such as mineral processing, particularly zinc and copper processing, have registered positive growth rates. Cement production has registered positive growth rates, and also beverage production, beer and soft drinks, that has also showed some growth during the past 6 months. For 2019 as a whole, we still believe that the economy is going to be weak. We are busy revising our outlook for 2019 so that we will inform the public as soon as we have those numbers finalized. But the picture that we see is still the same, that the economy is going to be weaker, or is going to be weak this year, just like it has been last year. When it comes to inflation, inflation continues to be manageable, and this is good news to all of us, that prices are not running away. For the 6 months of this year, the average inflation is standing at 4.4%, coming down from 5.6% in the corresponding period of last year. So as you can see, this is a positive development, and that's on account of a cooling down in the housing market, mainly. For 2019 as a whole, we expect inflation to average at 4.3. Now, that's good news, and therefore, for everybody who's going to negotiate for any inflationary salary adjustments, inflation is not at 10%, because we seem to have this 10% stuck in our heads. Inflation is projected to be at 4.3, and therefore, if it's really an inflationary adjustment, that's the adjustment that people should demand, not more than that. So that's good news for all of us. When it comes to credit, domestic credit going to the private sector has increased a little bit. For this period, it's standing at 6.9 from 5.9%. As you can see, it's a small uptick, and that is mainly going to the business sector, which is a good development. Business such as mining taking up more credit. Retail trade is taking up more credit, and also real estate is taking up more credit. Hopefully that's for investment purposes. What we're seeing on the individual side is also a good development. Credit is slowing down, and that's something. It's a development that we encourage, that as households, as individuals, this is not time to accumulate more debt, but this is time to save. So the reduction in credit going to households, to private individuals, that's a good development, and we'll continue to encourage that development. It's time to save and save and save and save. When it comes to international reserves, remain healthy. Expressed in terms of import cover, 4.8 months of import cover, so that is healthy to support our international obligations, but also at the same time maintain the one-on-one link between the Namibia Dollar and the South African rand. We also have a new development that we want to share with you, as you can see in the press statement, about the loan-to-value ratios. Usually we will do this when we discuss financial stability issues, but we thought this is an opportune time to share the information with you. You are aware that in March 2007, the Bank of Namibia introduced what is called loan-to-value ratios. In other words, if you are borrowing for a property, for some you have to put down a deposit, for some you don't have to put down a deposit. That was introduced in March 2017. And the reason was that that was meant to be used as a macroprudential tool. And macroprudential tool is nothing else than really regulations that are aimed at reducing risk that could threaten the stability of the financial sector as a whole. So that's what macroprudential regulation is all about. And the idea, or the reason why it was introduced, you may recall that the housing market was overheating, And we introduced that regulation to try and mitigate the negative impact of an overheating housing market to the financial sector. As you know, you have seen in history that economies can collapse if the financial sector collapses. We have seen it in 2009 when the whole economy came to a standstill because property markets were overheating in one country, and that has affected all of us. So risk to the financial sector coming from the overheating housing market can be dangerous. That's why we introduce LTV, or what is called the loan to value ratios. We have been assessing that, the impact of that regulation. And since then, since their introduction, a number of things have happened. First of all, the economy slowed down, and secondly, the property market and the housing market has cooled down significantly. So the risk that we have seen that time have come down quite significantly, and therefore, at our last meeting of last year, which was December, monetary policy meeting, we have decided to do a thorough review of the LTV ratios. That thorough review has taken a number of months because it means we also have to consult with the relevant stakeholders. We have to consult with banks to see what will be the impact of the adjustment. We have come to a conclusion. We have come to an agreement with the Minister of Finance because this is a regulation issued in terms of the Banking Institution Act, but in terms of that law, only the Minister of Finance issues regulations. So this regulations was issued by the Minister of Finance. So we also had to have discussions with the Minister of Finance. We have now come to an agreement that it's time to adjust those ratios. If you look at your statement, there's a table there that gives you a summary of these adjustments, which is nothing else than if you are borrowing for the first time, you only have one mortgage for a primary home, you are staying in that home, you are not going to be asked for a deposit when you are borrowing. So if a property is 100 Namibia dollar, you can get a loan of 100 Namibia dollar from a bank. Of course, obviously, if you can put down a deposit, it's even better for you because you will end up paying less interest rates or interest charges on that property. So the higher the deposit that you put down, the better for you. But the bank is not going to demand that you put down a deposit. For if you are going to have a second mortgage because you want to have a holiday home or you want to have a rental flat or house, the old regulations demanded that you should put down 80%. Now you are going to be asked to put down a deposit of 10%. And if you are going to add a third mortgage, and these mortgages are running, you still have the first one and second one and third one, and as you can see, that can create risk to the financial institutions. If you have another one, a third one, you will then have to put down a deposit of 20%. Previously, beyond that, you still go on deposit of 30%, deposit up to 50%. Now we are stopping at 80%. So even if you have a fourth and fifth mortgage, you are going to be asked to only put down a deposit of 20%. So it stops at 80. It no longer goes down to 50. So those are the new adjustments, and and this will become effective once the regulation is gazetted by the Minister of Finance, and we hope that will not take too long. But we still believe that at these adjusted levels, reasonable levels, and they will help us to continue to shield risk to the financial sector going forward. So that's more or less in summary what we have discussed at the monetary policy meeting yesterday and what we wanted to share with you. Thank you very much for your kind attention, and we can have a discussion.
Morning, I'm Jo Marie Daddy from Republican. Governor, if I remember correctly, when these LTVs were introduced and the housing market was starting to overheat, one of the reasons that it was introduced was also to stop the speculation and allow newcomers to enter the market. With the significant reduction now, won't it fire up speculation again, firstly? And secondly, is this also a way to try and stimulate the property market?
You mentioned in 2017 that homeowners will no longer be allowed to use the, equity in a first home for the purchase of a second. Is that the case still, or it has changed? Then secondly, is this not an admission of failure in policy? Just 16 months after you have a major policy, then you change it. Your views?
Yes, the speculation, Jomari, the idea, as you correctly remember that time, we were concerned about people excessively borrowing to invest in property markets, and part of it was speculation, and that was fueled by debt, and 100% debt. And that time, you may also recall that housing valuation was quite strong. In fact, our estimates were that properties were overvalued by in the region of 20, 30%. Since then, there has been a correction in the property market. So we believe that most properties are now more or less at the normal level. And therefore, the risk to the financial sector is significantly reduced. So if there are still people who want to invest, the opportunities are still there. The LTVs have not gone away. They are still there. Remember, we didn't have them before. They are still there. You still have to put down a deposit, because we believe that you need to have, as a borrower, you need to have, especially if a borrower of many loans, you have to have a skin in the game. So a deposit is basically your own money that you have to introduce, so you have to have a skin in the game. So if you are going to borrow to speculate, it's good. That's part of business, but you need to have your own money in there. So that has not gone away. That is still there. I hope I have answered your question there. And Francis, again, you can borrow and use that money as a deposit. The idea of a deposit, it should be your own capital, it should be your own money. So you can't say, I have equity in my primary mortgage, and therefore let me go and borrow, to tell the bank that I have my own money. Yeah, that tantamount to cheating, isn't it? That likes cheating, because you are now killing the objective of this regulation. You are defeating the objective of that regulation. So that is not allowed. So that principle still remains in force. Why the review after this period? LTVs, as I said, are prudential tools, macro-prudential tools, just like interest rates. And these things are subject to review. They are not things that are cast in stone. So we need to review them regularly in accordance with the conditions in the economy. As I said, the conditions have changed significantly since their introduction, and therefore we believe an adjustment is warranted at this moment in time. So we will continue to review. If we believe that conditions change again and that warrant a change in the LTVs, we shall do that. But you must not look at LTV something that is cast in stone. It's like interest rate. We review and we change.
Sorry, the second part of my question.
Okay.
Will it stimulate the property market?
Hopefully those that could not afford 30% or 50% to invest in a second property, in a third property or fourth property, will now find it affordable to do that. So I think that could be the spin-off of that. But I'm also aware that if you look around, there are a lot of properties that are looking for tenants. So it looks like the demand for properties, for rental properties, is also is also a bit weak. So I think we probably should not expect too much in terms of, seeing more investments in additional properties, because we probably still have to meet the current demand before people start to aggressively invest again in the property market. But I think it could be a push in the right direction, and hopefully that will also help to stimulate growth.
Yeah, good morning. My name is Brigitte, freelance journalist. I've got two questions on that. Just for clarification, wasn't it a recommendation of the high-level panel on the Namibian economy to remove that restriction for second and third and fourth property buyers? And my other question is, if you talk to estate agents, why the property market is rather flat, it is apparently cheaper for young families or couples to rather rent for 8,000 or 9,000 per month than coughing up if you buy a property for 1.5 million or 1.6 million and you've got to put down, even if you're a first-time buyer, a 10% down payment or deposit. You still got to cough up 15,000 Namibia dollars per month, plus a levy, plus water, electricity, etc. So it's cheaper to actually save 10,000 per month and live in a 7,000 or 8,000 Namibia dollar two-bedroomed property. Isn't there a danger that exactly people will rather rent out or rent than buy?
Okay, let's start with the last one, Brigitte. I'm not sure whether I fully understand the concerns of the couple. You say this couple is cheaper for the couple to rent than buy because property prices are still high. Is that the understanding? Yeah. Yeah. I still believe that housing prices are still high in Namibia, especially the top end. The correction that we are seeing now, I think, is a welcome development. And I think we should still continue to invest in housing, making land available, making housing available so that prices can come to the normal level. As I said, I see that development I see that taking place. I see prices cooling down. I think that's a very good development. So we want to see more of that. And you will probably find more and more people who will be able to afford properties at these new levels once that trend continues. But it means we need to continue to invest more, especially in the low-cost housing. That's where I see the biggest problem. People are in that market segment are still not able to find properties at the right level. And the solution, in my view, is really to service land and make affordable land available so that those who are in the business of constructing houses can construct affordable housing. So for me, that's a sustainable solution. The high level, and maybe the other thing, the other point that I need to mention is that for that couple, if it's really their first mortgage, they don't have to put down a deposit if they don't have the deposit. As I said, if they do, it is actually a reasonable thing to do. It's a wise thing to do because it means you are going to reduce your interest cost. Because when you buy a property and you borrow, probably for the first 5 years, the money that you're paying is just paying interest. But you have a deposit, you could actually pay your house faster than somebody who is taking 100% loan from a bank. So if you have money to put down as a deposit, that will be my advice. But for somebody who's borrowing to have only that mortgage, and that mortgage is for a primary home, the previous LTV requirement and the current LTV requirement are exactly the same. You don't have to put down a deposit. So you can still get 100% loan from a bank. For the high level panel, yes, I think they also made the same recommendations that the LTVs must be reviewed. Well, everybody has got a view on a number of things, including the high-level panel. We welcome their views on a number of issues, including the LTVs. But as I said, we actually started reviewing this already from the beginning of this year. That decision to review the LTVs was taken in December last year when we had our last monthly policy committee meeting. So we welcome their input, but it's not because it's inspired, and despite of what they have said, we have already started reviewing these regulations.
Thank you. My name is Kevin. I'm a reporter and presenter at Ego FM. Just a few days ago, economists and investors were saying that the global economy is heading towards a recession, if it is not in a technical recession already. During the course of this week, we saw the UK economy slowing down, Germany economy slowing down, Italy affected, escalation of the US-China trade war, China slowing down for the first time in 27 years. How disquieting are these developments, considering that the EU is quite an export destination for us? And maybe your comment on what's happening in South Africa right now. I think just a few days ago, I think we've seen how the rand was being buffeted over the few days past, and with some experts saying that it's one of the most poorly performing currency at this point in time. How big a concern is that for you, the slowdown in the South African economy? The IMF has already cut growth prospects to 0 point something %. What does that mean for us as we are trying to get out of the water?
Thank you. Governor, how concerned are you about non-performing loans at banks, especially mortgage loans? And was the interest rate reduction, is that also to address that? That's the one question I'd like to find out. The other one is, how concerned are you about especially households' short-term borrowing in terms of personal loans and credit cards?
Okay. My name is Joseph. I'm from One Africa TV. Governor, I see here on the domestic economy, they're saying the activity has slowed down in the first 6 months compared to last year. I'm sure you are well aware that the assumption out there is that by next year, the growth, the projection is that the growth would be at 2%. Now, how are we supposed to get there with this weak performance?
Sorry, just in addition, I think I forgot one of my questions there. What's informing this projection of 4.3% in terms of the inflation, considering that we are in one of the most crippling droughts we've ever faced as a country, and also the weak economy in South Africa? What's informing this 4.3% inflation projection for 2019?
This is Michael. I'm from the Namibian. I just have a question in regards to like the sort of excessive liquidity that we're building up. Globally, we're heading towards like a global recession, meaning that the rate cuts are also going to like reduce the yields and everything. So which means that most investors are probably moving their money more into fixed income securities. And at the same time, we saw at the economic summit that the money that was pledged and the ones that is going to be invested in the local economy. So which means that there's also a promotion in equity as well. So now, does that mean that we're also seeing like an imminent review in terms of the interest rate? Will it remain unchanged, or are we looking at a possible review like in the near term, and will our economy be able to absorb all this excessive liquidity?
Just clarify the last part of the question. The excessive liquidity is coming from, why are you worried about the excessive liquidity, and it's coming from where? Just that part. Mostly
in like the money that we're bringing in, like promotion of this. I see like these rate cuts will, the demand of fixed income securities is already high at the moment, despite like the dwindling like yields in bonds like globally, but ours in South Africa continue to increase. Now, most of our investors are investing in these fixed income securities. And then we also saw the economic summit, the money that was raised there, it's also promoting the equity market as well. So now we have both the equity and the fixed income being promoted at the same time. So there's a lot of money in our economy. So are we really able to absorb all this? Like, do we have enough structures to absorb all these monies that is available?
Can we start with Kevin? I believe global growth. Yes, Kevin, your concerns that growth is slowing down are legitimate, but we don't see a recession yet. In the U.S., the economy is still growing at healthy levels. although it has slowed down. And as I said, that slowdown was expected because the economy cannot continue to grow above normal growth rates for a long time. So that will create instability because that is unhealthy. So the slowdown was expected. And as you know, in the US, the economy is so strong that unemployment is at the lowest level when you look at the historical, when you look at it from a historical perspective. Unemployment of 3.5%, it's way below what is normal in the U.S. So the economy is still growing at healthy levels. In China, yes, there has been a slowdown, but China is still growing in the region of 6%. That's like adding a Japan every 13 months to the world economy, and Japan is the third, fourth largest economy in the world. So 6% is still huge. Still huge. Of course, we will want all those economies to grow at the high levels, China to grow at the higher level than 6%, and hopefully they will continue to, or if they can grow at high levels, they can buy our minerals, our meat, but still 6% is still not something that should cause a serious concern. So at this moment, no recession yet, but you're right that if trade tensions could escalate, that could create further problems for global growth. But the normal scenario, if you like, the normal scenario is that growth is going to stabilize at that level, and hopefully by next year, if you look at the IMF projections, by next year growth is going to pick up again. That's what the IMF expects to see. But of course, that's on condition that trade, this risk that we see in the world, specifically the trade tensions, do not escalate. If they escalate, they could shut down global trade, and that could further reduce global growth. So hopefully that scenario does not pin out, and therefore growth could continue to be stable again. I hope I answered your question on global growth. Yeah. So maybe I can cover you in the same breath. We talked about South Africa. You talked about the rand, the performance of the rand, which is true. The rand has shown some weakness over the last few days. Is it because of what is happening in South Africa? Probably, partly, probably not. Part of it is basically because people are worried about the escalation of trade tensions, and of course the rand being a currency that is traded all over the world, it will be affected by such developments. So that's why the rand has reacted over the last few days. Of course, South Africa as a country has got its own challenges, just like all of us. You are aware of the challenges with regard to power. Some people are concerned about that, and it's just our hope and believe that they will do what needs to be done to resolve these issues, so that the economy can get on a stronger footing again. A stronger South Africa, it's good for Namibia. So we will not want to wish South Africa to weaken further. We will actually want to see a stronger South Africa because, first of all, they are our neighbor. You don't want to be in a bad neighborhood. Secondly, we get a significant part of our revenue from a customs union. And therefore, if the economy is not growing in South Africa, that will negatively impact on the circle revenue. So we want South Africa to be healthy. We want South Africa to grow higher, and we hope that these issues will be resolved soon. I hope I answered your question on South Africa. On inflation, what gives us confidence that inflation will be contained? Again, as we have seen that inflation for the last few years has really remained reasonably low, in the region of 5%, 6%. And we don't think there are any developments in the domestic economy or regional economy that will put further pressure on inflation to rise faster. So we still believe that 4.3 is a reasonable estimate. As I said, much of the downward pressure of late is coming from the correction in the housing market. And that's connected to what I said earlier when I was talking the LTV. With this slowdown in housing market, it's also helping us to contain inflation. And hopefully we'll get more rain, and therefore, and again, food will also not put too much upward pressure on inflation going forward. So for now, we're not worried about inflation. We believe that that projection is quite reasonable and is achievable. Joe Marie, yes. And the non-performing loan ratios, these are always symptoms of economic stress. And this say that risk build up during good times and they show up during bad times. So we were all celebrating when the economy was growing. Yeah, we were all happy, but we were also excessively borrowing. Now, some of those borrowers are no longer able to pay back the loans that they have taken. And we are starting to see that now that the economy has slowed down. So as a result, NPL, the non-performing loan ratios have increased. Still remaining reasonably within the manageable levels, but yes, certainly it has increased. Can the banks absorb that? We believe that the banks are able to withstand those shocks, those higher NPLs, because they are prudent. They have been prudent. They have put aside some of their profit to keep their capital levels high, and therefore, even if there are people who are not able to pay back loans, they will still be able to absorb that and remain healthy and stable. So we're not too overly concerned about that. So the situation at this point in time it's manageable, unless things change significantly again. But I think for what we see at the moment, the situation is quite manageable. Are we doing this to mitigate against this? No, we don't reduce interest rate for the sake of helping the borrowers. Interest rate is actually a monetary policy tool and you know our monetary policy is really aimed at protecting the one-on-one link between the Namibia dollar and the rand. It doesn't look at any other metrics like NPLs, and therefore we need to soften the blow to the borrowers and the banks. So if you have taken money, you should carry that responsibility. If you have lent money as a bank, you should carry that responsibility. That's not the responsibility of monetary policy. I hope I answered your question, Joe Marie, on that one. Is there anything that...
About the short-term debt?
Yes, about the short-term debt. I was coming to that one. Short-term debt, yes, that certainly we have seen because of this pressure. It looks like because of the pressure in the economy, people are now resorting to short-term debt. We have seen the category called other loans and advances that includes personal loans that we have mentioned, that has been rising. And I think the latest number that I have seen is that that category is rising in the region of 23%. That's a concern. And it looks like people are still borrowing to support their consumption activities. That's why they are taking out these short-term loans. I don't believe that it's sustainable to continue funding our lifestyles with short-term loans, especially consumption loans. My advice, again, cut where you need to cut. Where it's possible, cut. And don't incur additional debt, because it's going to create problems for you as a borrower, it's going to create problems for those who are lending, and it's going to create problems for the economy. So I'm equally concerned as you are on personal loans and the short-term loans in a form of credit cards. So my advice is really cut. We need to cut where we need to cut. We should not continue to live a lifestyle if we are not able to afford that lifestyle. Joseph wanted to know whether the 2% growth is achievable. I will be able to confidently answer your question in the couple of weeks when we look at the revised outlook. So as I said, we We are busy revising the numbers. The preliminary information so far is that the economy is still going to be weak this year, and mainly because of diamond, agriculture, wholesale and retail trade. We believe the situation is going to be better next year. Whether it's going to be 2%, whether it's going to be something less than that, it's still early days to say. With the revised numbers, we will be able to give you something more concrete. At this moment in time, I will not be able to do that. So let's wait for that moment. The last question on the gentleman from the Namibian who is worried about too much money coming to the economy. I think that's of a lesser evil for us to be worried about. If somebody there's a lot of money, I think that money can be managed. Yeah, no, we're not concerned about interest rate going down and therefore stimulating demand for fixed income. Again, investors have a choice. If you want to put your money in fixed income, you can put your money in fixed income because you see returns there. And it's always the case that when interest rates go down, fixed income become attractive because you can make more money from fixed income. So I think if the investor believes that that's the right strategy, we shouldn't be too worried about it. Those who are putting money in equity, again, that's actually a good thing. We're talking about the summit, that people have pledged money, and that money is going to real investment. You know, if you're going to put up a solar power plant to produce electricity for us, first of all, you are solving our electricity problem. Secondly, you are going to employ more people. That's something that we want to encourage. So I'm not concerned about those who have pledged to invest, to put money into real activities, bricks and mortar. So I think that's something that we appreciate, and that will encourage more and more of that. So I believe we shouldn't be worried about that.